In this video, I'm going to share with you one of the most underutilized option trading strategies that you should be using. I'm going to give you all the details of this option trading strategy, as well as the two ways that I like to use it. Here's an example trade we did with this strategy. On June 26th, we sold the CI January 17th of the next year, so the option expired in 7 months. We sold the 280 cash care put option. For that, we got $4.10 per share, or $410 for selling this put option contract. So how can we make money by selling this put option? Well, there's two ways you can do this to your benefit. The first one is the income we collected. That $4.10 per share, that's potential income, and potentially the whole $4.10 per share can be yours if the trade works out for you. And in fact, we still are in this trade and it is working out for us. Here you see that put option contract we sold. Notice that right now we have an unrealized profit of $101 because we haven't closed this out. But if we wanted to, we could close this position out right now and have a profit of just over $100. Now I'm not there yet. I want to stay with this position. And there's several reasons why, and I'll get to those in just a minute. But that option premium is one reason why people like to sell put options. But there's another one. Let's talk through the other scenario here of why you should consider selling put options. Where you see this yellow arrow, that's the day we did this trade. It was June 6th, and CI was trading for around $334 per share. And here's some notes I wanted to share with you. Now, CI typically trades for around a 12 P to E. On that day, indeed, it was trading for around its average of around a 12 P to E. But remember, we sold the 280 put option. That option was way down here. In fact, that option was around 16% out of the money. I like CI as a company because it shows consistent earnings growth. Its earnings are fairly stable. You don't see a whole lot of fluctuations with those earnings. I really like that in a company I'm trading in. But the problem is that it's trading at a fair market value. It's trading for about where it typically trades on average over the past decade or two. That doesn't get me very excited. But now the ability to buy a stock at a 16% discount that's very consistent with its earnings and earnings growth, now that gets me excited. So the other way you can use these put options is to sell put options to companies at prices you'd be happy to own them at. And remember, we got paid up front $4.10 per share for doing that. So let's say we wanted to buy CI at $280 per share. Well, in reality, we're only out of pocket around $276 per share because of that $4 we got up front. So it gives you the opportunity to buy great companies at a really nice discount. And if you don't end up being able to buy at that discount, well, you get to keep the option premium, which in this case is $4.10 per share. So if it's such a great strategy, why isn't everyone doing it? Well, part of it is the perception of selling put options. As you see here on Business Insider, the perception is that they can involve significant risk. And that is true. If not traded properly, they can produce significant losses. But if traded properly, they can be an extremely valuable and powerful tool, as you just saw. So the next question is, when should you sell put options? Here you see another trade we did where we sold a cash care put option. On August 6th, we sold the STT September 20th $70 cash care put option. We got 85 cents per share for that. So let me talk through why I did this. It'll help you see when you should consider selling put options. There's two things I like to see when I sell a cash care put option like this one here at STT. First of all, I love it if the company is already undervalued or selling for less than what it typically sells for. That is the case with STT. When I did this trade, I believe that it was potentially undervalued. And not undervalued by 1 or 2%, it was potentially well undervalued. Here's the day we did this trade, August 6th. Notice what have recently happened with the stock price, because this is the second thing I like to see when I sell a cash care put option. Notice how the previous month or so, it had a really strong advance of around 17%. It then topped out, found resistance, and came right back down. Notice where it came back down to, just above this red 200 moving average. Notice what tends to happen around this red 200 moving average. If I zoom out here a little bit, you see that it tends to find support around that moving average. After the big advance and then the big decline, volatility had spiked for STT, but it was finding nice support around this red 200 moving average. Now remember, I believe the company is already well undervalued at this price. It had now come back down and was finding support at an area that I expected to find support at. Because of that, I felt comfortable selling that cash secure put option. So how did the trade turn out? Remember, on August 6th, we got 85 cents per share for selling that put option. Fast forward just 10 days to August 16th, we bought that put option back for an 80% profit. We bought to close the STT September 20th $70 cash care put option for 15 cents per share. Why was it such a good trade? Well, I sold put options in a company I believe was already potentially undervalued by quite a bit. I sold a put option when the stock had come down and appeared to be finding support. Notice what I didn't do here. I didn't sell this put option in a way overvalued company. I sold in a company that has consistent earnings. They have consistent earnings growth. Yes, the earnings do bounce around a little bit, but overall, over the long term, they have nice, consistent earnings growth. I also sold a put option in a company whose stock price isn't overly volatile. So I have an undervalued company that's finding support and it's selling at a discount. That to me is a perfect combination of when is the right time to sell a cash carry put option. I like to pick companies that have a history of growing their earnings. Those earnings are consistent in many different market environments, good and bad environments. I don't like to trade them in overvalued companies. I want my companies to at least be fairly valued, or even better, I like them to be undervalued, like STT is in my opinion. Now, there are lots of other option trades you can use selling put options in. For example, you can use them in credit spreads. You can sell them in longer term put options known as leaps options. You can sell put options in the money. You can even use them in option chain strategies like a risk reversal, as you see here in Hershey. Let's talk through this risk reversal I did in Hershey to kind of help you see another way you can use selling put options to put the odds of winning in your favor. Here you see a trade we did on January early this year. It's known as a risk reversal. Notice the two legs it was made up of. First, our income portion. We sold the Hershey January of next year, so the option expired in about 12 months. We sold the 150 put option. If you look up here on this bottom line here, you see we got $3.61 for selling this put option. We used that income to buy a call option. So we bought to open the same expiration day, January 17th of next year, 250 call option. For this overall trade, we put 32 cents per share in our pocket. Now keep in mind what can happen here. If Hershey declines, we might be on the hook to buy it for $150 per share. Now there's lots of things we can do to avoid that from happening, but to keep it simple here, that's what we're looking at. But if Hershey were to go up in price, we might potentially receive some benefit from that stock price appreciation because of the 250 call option we own. So how'd this trade turn out? Here you see the trade we did about 4 months later on May 15th. We adjusted our risk reversal in Hershey. Basically, we took our risk off the table and we lined ourselves up to continue to receive profit if Hershey were to continue going up in price. So what exactly did we do? We bought to close our risk. We bought to close the Hershey January 17th of next year 150 put option. But again, we did it for a credit. And how do we do that for a credit? Well, we sold to open that same expiration day, January of next year, 270 call option. And we did this again for a small credit of 15 cents per share. So what might potentially happen here? Well, at this point, we're guaranteed to win. We've taken all of our risk off the table. We got a credit when we entered this risk reversal. We got a credit here when we took the risk off the table. So we're guaranteed to win. There's the potential to sweeten this pot a little bit. Look down here at the notes I shared on my Patreon when I posted this trade on my Patreon group. Because the 250 call option we own and the 270 call option we sold, there's a spread of $20 per share. If Hershey were at or above 270 at expiration, we have the possibility of making another $20 per share. Will that happen? Well, maybe, maybe not. And the way it's looking now, maybe not. But what I like here, so we put ourselves in a position where we can't lose on this trade. Our risk is gone. We have the potential for a nice big win of $20 per share if Hershey were to go way up in price by January of next year. Let me walk you through another real life example to show you how these trades should be done. Here you see another put option we sold on July 12th in KR. That's the Kroger company. It's a grocery store chain. We sold the August 16th $50 cash carry put option. We got 32 cents per share for it. Now, why did I sell this put option? Why did I sell the August 16th put option? And why did I sell the $50 strike price? First, why did I pick KR or the Kroger company? Well, look here at the notes I've made for you. So we sold this put option on July 12th. At that time, KR was trading for around $52.50 per share. At its current price, that's about 11 PDE or price to earnings. Now, typically, as I show you here, it trades around a 13.3 price to earnings. And that's over a long period of time. Over decades in time, that's KR's average price to earnings, 13.3. It was trading for 11. Now we sold the $50 strike price. If we ended up having to buy it at that price, which wasn't our plan or our goal with this trade, but if we did, notice that would put it at a 10.8% price to earnings approximately. So that'd be a tremendous discount from where it typically trades at, and nothing has really fundamentally changed with the company. It's still a very well-run company. It's just trading at a perceived discount right now. So that's why I picked Kroger. Now, why did I pick the $50 strike price? Well, notice what had recently happened with the stock. It had come down and show weakness. It found resistance at this green 50 moving average on June 20th. It then came down even lower. It made a new lower low, which is a negative. I agree with that if that's your thinking. But then it pushed through that green 50 moving average and came up and found support at that moving average 1 day, 2 days, and then the day we traded this. So it appeared that it formed a new base, was finding nice support at that green 50 moving average. That's exactly what happened. Over the next month or so, it continued to find support above that green 50 moving average. So the technicals put the odds of us winning in our favor. It had broken through an area of resistance. That green 50 moving average had come up, come down, was finding support there, and appeared to be ready to take off again. And that's exactly what it did. So fundamentally, the company was undervalued in my opinion. Technically, it was at support. I like that. And a little kicker here was that if it declined, it would have to decline below this red 200 moving average, which if you look back here, that moving average tends to serve as support for it multiple times over the previous year. So if it did decline, you have to push through that red 20 moving average before my $50 cash card put option was challenged. So the technicals were definitely in our favor here. One more little kicker as well, if you look at the weekly chart, is notice it's also around the green 50 moving average on this weekly chart. So that was just another technical support that we had in our favor. And notice that $50 level where we sold that cash card put option, it was at a level that had previously served as strong resistance for it. Remember, resistance once broken through, it tends to turn to support. That's exactly what Kroger was experiencing. That resistance around 50 had become support. So how did the trade turn out? Remember, we sold the option on July 12th. Fast forward 1 month, we bought it back for an 80% profit on August 12th. We bought it back for 6 cents per share. I like to sell put options to companies that I believe are already undervalued. I like to sell them when they're around some technical support and appear to be finding support at that level. And I also like to avoid earnings. One reason why I close this out because I want to avoid Kroger, who's scheduled to announce earnings soon. This strategy of selling put options, whether you're doing risk reversals, in the money puts, or longer term leaps put options, to me it's only appropriate to do so with companies that are fairly valued or even better, undervalued. I typically don't like selling put options to companies I believe are overvalued. Why would you want to sell someone the right to sell you a stock that's already overpriced? In my opinion, I don't like to do that. Now there are certain scenarios where I will sell put options in overvalued companies, but they're very specific situations and with a very specific strategy. But overall, this is my strategy. I like to pick companies that have a consistent record of growing their earnings and that are consistently profitable and are finding some sort of technical support. If you're new to selling options, why not consider selling put options in companies that are potentially already undervalued and are finding technical support? Make sure these are highly profitable companies that have a long history of growing their earnings. Don't sell options in high volatility companies just because the option premiums are a lot higher. Sell put options in companies that you feel comfortable if they were put into your account. Sell put options in companies that are solid companies and have a proven track record of being successful. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. If you'd like to see how I find those potentially undervalued companies to buy outright or to sell put options in, check out the video at the link above in the description below entitled The Ultimate Guide to Long-Term Stock Investments. Until next time, happy investing, and we'll see you again soon.